Thank you, and thank you for this invite. I have to say it's not every day that you go to a conference and the launch of a new actuarial valuation system is the hot news off the press, but there we go. That's the exciting world that we live in. I'm going to talk to you, I've called my talk Perambulations Through Pensions Policy, and it is a kind of little bit of a ramble, and some of my reflections kind of reflect the fact that I was at the Pensions Regulator for 5 years, from 2018 to 2023. I sort of left the regulator because I thought there was probably not going to be anything new in pensions policy for quite a while, but you know, as we'll probably see, I was quite wrong. I do think we are at a really interesting time in terms of pensions policy development. I do think it's going to change all our lives, all of those of us working in pensions, very significantly. So I think some of us are going to get some new things to do. Some of us perhaps will change what we do. But I think the scale of the change is such that there'll be some people sat in this room who perhaps in 5 years' time will not be working in pensions anymore because their job has disappeared. It's quite depressing, isn't it? There we are. I think some of the change that we're now seeing, I saw the beginnings of during my time at the regulator. My 5 years at the regulator was a sort of fairly hectic time. We did have a few elections. We had Brexit, lots of planning about whether the world would end with Brexit. We obviously had the pandemic. And of course we had, for a very short period of time, the Liz Truss government. And I have to say I'm very grateful to Liz Truss because she created some of the most interesting times of my period at the regulator. So it wasn't short of change, and probably one of the big jobs that I had was introducing Pensions Act 2021. The headlines around that were creation of new criminal sanctions, so you could go to jail for 7 years. If you did the wrong thing, you could have £1 million fine. That tended to dominate the news. But within that, there was also new funding codes, CDC schemes, collective money purchase schemes, technically, new CDC schemes. And then, aside from the Pensions Act, I also introduced a interim super fund regime, which is around consolidating DB schemes. It's only taken 7 years to move from an interim regime to now in the Pensions Bill of Full Authorisation regime, which is longer than I anticipated when I was at the regulator. And I also introduced the first consultation on value for money. So you can thank me very much for all the work that you're going to have to do on value for money. And I'll sort of come back to some of those because I think they are kind of relevant of where we're going. But towards the end of my time at the regulator, still with the Boris Johnson government, there was a real focus on how do you drive growth in the economy. And Rishi Sunak and Boris kind of looked around for where they could drive growth, and they hit upon pensions and decided there's a lot of money in pensions. So actually, if we can get pension schemes to invest in the right way, then that will help the UK economy come back in a post-pandemic world. And they did think quite hard about mandating investment into the UK economy. I was one of those very unpopular people who had to say, actually, legally, I don't think that you can do that. And there was sort of very long silence on the telephone when I said that. But, you know, they did publish a letter where they talked about mandating and saying that they had stepped back from that. But I think once you put that idea into government, that changing investment in pension schemes could drive the UK economy, it's not something that any future government is going to forget. So the idea that we might get to a government that's no longer interested in pensions and the way pension schemes are invested, I think is just not going to happen. They are always going to have that interest. One of the interesting things for me is where they kind of hit upon policy. And you might recall, might not, that there was a Tony Blair Institute paper. It's quite a radical paper saying that consolidation in pensions would be a good thing. And in defined benefit world, it talked about consolidating the 4,500 smallest DB schemes. And there were only 5,200 at the time. But essentially, that proposal was every pension scheme that had broadly less than 1,000 members would be consolidated into the Pension Protection Fund, which of course Pension Protection Fund got very excited about that. But a lot of focus was on consolidation in the DC world. And the headline number in the Tony Blair Institute paper was there are 27,000 DC schemes in the UK. And it's patently obvious to everybody that 27,000 can't be the right number. What I think the paper overlooked is that 25,000 of those 27,000 schemes are small relevant schemes. They only cover 70,000 individuals. So you can consolidate 25,000 of those schemes and not move the dial 1 inch, a complete red herring. But for me, it's sort of quite interesting that both within government and within this think tank, the sort of idea was created of let's consolidate pensions because that will then mean that they're run more efficiently, but also create investment in the UK economy. If you look at DB world, as I say, 5,200 pension schemes, proposal was to consolidate 4,500. If you look at the DB world, there are 2,000 DB pension schemes that have got less than 100 members. So reasonably and sensibly, you could consolidate those, and that would be a benefit in terms of better governance, efficiencies, and so on. At the other end of the scale, there's something like 160 schemes that have over 10,000 members. Those top 160 schemes have more assets than the balance of the pension schemes. So it's a very skew distribution. And the same is true of the DC market. But in fact, the DC market has been consolidating and consolidating quite quickly. So back in 2012, there were 3,700 DC schemes. At the time of the Tony Blair Institute, there were 1,100 DC schemes. And when this government came into power, they were saying we need to drive consolidation within the DC market even faster. Now there are probably less than 900 schemes. Just over 400 of those have less than 100 members. So actually it's quite easy to see that probably around 100 of those schemes might disappear in the very near future. And in part, that's because of the regulatory burden that this government and previous governments drove. So when I was at the regulator, we had a value for member test for schemes of under 100 million. You obviously have the value for money test that's being introduced. So the sort of regulatory burden is being ramped up to a degree that small schemes just give up and consolidate into master trust. But you can see of the 900 or so DC schemes that are in the market at the moment, as I say, 430 of those will potentially disappear quite quickly. And what this government did, I think, is sort of sit down and say, what are we actually trying to achieve? Are we actually trying to achieve superior governance through consolidating all those small schemes? And it would be fair to say the regulator, survey after survey, says small and micro schemes tend to be less well governed than larger schemes. Not universally true, but generally that is true. So actually, if you consolidate those small schemes, then you will improve governance. People will end up in a scheme which is better run, better governed than it otherwise might be. What you don't get is if you merge just the small schemes, is a significant amount of money that you can invest in the UK economy. What you have to do is, if you want to create a pool of bigger assets that will drive growth in the UK economy, is merge significantly larger schemes. And this government hit upon that relatively quickly in its term of office. So its proposal is the creation of mega funds with a £25 billion default minimum size. It's kind of interim for schemes that have got high levels of growth. But they set the target at 25 billion. And if you look back at the stats in Corporate Advisor last year, there were only 3 master trusts in existence which had funds over 25 billion. It's one that was quite close, but you can see that actually that measure is going to drive quite seismic change within our industry. already consultants who are recommending DC master trusts are not recommending those master trusts that they don't think will hit the 25 billion threshold. So it almost doesn't matter that the legislation is not in place. The market reaction to that minimum is to say we're going to direct business to those that we think are going to make the 25 billion. They're going to be around in the long haul. So very, very quickly, you're going to get down. I sort of think this government probably wants 6 to 12 DC mega funds. And if you end up with that number of large DC funds, they're going to grow pretty rapidly, pretty quickly. They won't be 25 billion, they'll very quickly get to 200, 300, 400 billion pounds. Now the government within the pensions bill, also the proposal that contract-based schemes either have to consolidate into bigger contract-based schemes or transfer across to master trusts. That potentially could see another 300 to 400 billion pounds come into DC master trusts. So you've got 6 to 12 mega funds, all of whom are 200, 300, 400 billion pounds in size, and suddenly they become quite important to the UK economy. If those funds decide to buy or sell the same asset at the same time, they are going to move markets. We kind of saw that in Liz Truss' government following her fiscal event. So close your ears, Taylor, don't listen to this bit. So I do think that actually that will create a bit of a challenge within the regulatory framework. If I was sat in the Bank of England and there are 6 to 12 institutions with 200, 300, 400 billion, where their investment strategy and decisions could move the UK market, I'd actually want to have much greater control and oversight over those funds. So I do think at some point, this kind of drive to consolidation into significantly less funds, but significantly larger funds, is going to mean that probably the Pensions Regulator is not going to have sole oversight and governance over those arrangements. I can't believe the Bank of England is not going to get very interested in how they're run. And if you're sat in this room, does that really matter to you? Well, I think it does, because if you're regulated by TPR or the FCA or the PRA, it will feel very different. The way that regulatory oversight impacts you will be very different depending on who has jurisdiction over pension schemes. There's obviously talk that actually this consolidation is good for member outcomes. That's the kind of mantra. What we're trying to do is create good member outcomes. I don't know that if you create a mega fund of 25 billion, do you get a significantly better outcome for members than if it was 10 billion or 15 billion? So I don't think this really is about member outcomes. This is about creating pools of assets that will invest in the UK economy and drive growth. That's the kind of key factor. So I do think that will change regulatory oversight. The regulator is already, I mean, in my day it was beginning to see the way the wind was going and start to say, actually, if we're going to have very, very significant pension schemes, we shouldn't be just checking whether they comply with different aspects of law. We should understand the people that actually are managing those organisations. We should understand how they make decisions. What's the governance structure? What's the organisational design within those entities? What's the culture like? Does the culture actually create good behaviours that are going to create better member outcomes? Are there rewards and financial incentives that drive good outcomes or might have drivers of behaviour which actually goes against that? So you suddenly need, within the pensions regulator, to change the skill set that exists, and that's been the part of the reason that there was a change of chief executive was to drive some of that change, drive to a much more supervision type level of oversight rather than just checking compliance with legislation. So, that's behind why some of the professional trustee firms, some of the administrators have been brought into supervision. The regulators wants to know how those organisations work, how they make decisions, how they deal with risk, how they mitigate risk. So that's quite a big change for the pensions regulator, which has not been used to regulation and oversight in that way. The FCA, the PRA, have done that in relation to insurance companies and banks and financial institutions, but that is going to be quite a change for the regulator. Also, when I was at the regulator, it was pretty true that if you were a master trust, you had 5 to 10 more cyber-related reported events than if you were a regular pension scheme. Why is that? Well, actually, master trusts are bigger, they hold more data, so they're a bigger target for cyber criminals to target. If you create mega funds that are significantly greater than any pension scheme that we have seen to date, they are absolutely going to be the target for cyber criminals. Because the prize, if you can actually get in or hold the database to ransom, would be huge. So these things are going to attract the unwarranted attention of the criminal fraternity. Because they're going to be administering millions, literally millions of people's pensions. They'll hold millions of people's personal data. They'll be hugely attractive. Of course, once you get to that size, then actually the resources that are available to you in terms of governance and oversight are significantly greater than for a regular pension scheme. In terms of the technology that they're able to investment, their deployment of AI, it will be significantly greater than is typically available to pension schemes. We worked with, when I say we, PASA, worked with Procentia on various guidance. Procentia is one of the expert partners of PASA. And within the sort of first booklet we had, there are various stages of digital maturity. And you'd have to say all mega funds are going to be in the super mature category. They are going to be absolutely using technology at its greatest. But in the interim, in order to form them, they are going to have to integrate and absorb lots of other pension schemes that are not going to be in the same place, the same level of sophistication in terms of technology and so on. So I think if you're in this room, the next 3 to 5 years are going to be incredibly challenging. This level of consolidation is going to be hugely taxing. If you've got skills around administration, you understand systems, you understand complex project management, you are going to be in enormous demand because the industry is going to go through quite a seismic change. And if that wasn't enough, we've also obviously got the pensions dashboard. I was quite excited when I was at the regulator about the dashboard because it was going to be pretty obvious to me where the gaps in data were going to be, where calculations had not been brought up to date and so on. So this was actually going to have a complete window into what was actually happening within administrators. But I think it's almost inevitable. We'll have that sort of Martin Lewis moment where he sends millions of emails out to people saying, log into the dashboard, find out if you've got any pensions missing, and everybody's going to log in all at the same time, and they'll find a little bit about pensions that they hold, but not perhaps all the information that they want. So they'll then start firing off letters, emails to their administrator saying, please, can you tell me more? So as administrators, the amount of traffic that is going to come to you and that you're going to have to send back post-dashboard will be a significantly greater level than it's been. And so if you're in a world where you have got most of your data complete and accurate, but some of it still sits in paper files in a warehouse, that's going to be a bit of a challenge. If you haven't digitized and automated your calculations, suddenly you're going to have to do an awful lot of manual calculations, which are going to prove expensive and time-consuming. So the demand for complete, accurate records, which are digitized, automated, is going to go exponentially through the roof. I think if you are going to survive in a post-dashboard world and you have significant manual processes, you are really going to struggle. You're going to struggle for resources, you're going to struggle financially, and it may become existential. It will be that big, in my view. So digitization and automation, I think, is almost going to be a prerequisite for pensions administration going forwards. And that's why, again, with Procentia, we're very keen to issue a publication which has got a methodology, it's got an acronym BRIDGE, which is how you work out where you are, where you want to be, and how you go through on that journey. I think the dashboard is going to force most pension schemes down that journey if they've not already done so. And I get that for many of us, that getting your sponsor or other people, trustees, to pay for investment in technology is incredibly difficult. And of course, we all know that actually if you make the big upfront investment in data, you digitize, you automate calculations, then the ongoing cost of administration falls quite significantly. But it does require you to make that upfront investment in getting that. And I don't think that really matters whether you're in-house, you're a third-party administrator, you're an insurance company. I think the case for that investment in technology is coming. It's quite interesting for me that even in the BPA market used to be all about price. So whichever insurance offered a trustees the lowest price, that was typically where the trustees would place their business. That seems no longer to be the case. Trustees are worried about the member experience post-transaction. They are worried about the quality of administration. So administration, even in a transaction which has typically been just driven by price, is beginning to change. I've sort of been very doom and gloom so far, but I do think technology gives us the ability to give people information at the right time in a way that they can digest, in a way that's not really been feasible before. On LCP's website, at the touch of a button, you can decide whether you want the report that you've got either in written format, you have it as a slideshow, or you can instantly turn it into a podcast. So the ability to get the right information to make decisions, but also in a format which you can understand, which you prefer, has never been greater. And in administration terms, it does mean that we can have highly personalized, highly tailored communications to members in a way that they are used to, that they prefer, to drive much better engagement. And if they have that, they will make much better decisions when they have to make those decisions. So this is a real opportunity in terms of technology and AI in creating much better communication and engagement with members. But it's not just the members, I think, that will benefit. Trustees, the role of trustees, how trustees engage with administration will change quite significantly. I sort of look back at the days when I used to get big paper packs of administration statistics of how many letters were replied to within the SLA and so on. Lots of very dry statistics, where now we're moving to a world where that's just provided online. You can see where all the administration cases have got to online. And so how you engage with administration in trustee meetings will change. So the regulator has just run a series of roundtables, and one of the things that they said is the current approach to running a pension scheme, evidenced by even a cursory review of board packs, primarily involves retrospective quarterly oversight and reporting, and addressing specific technical matters. TPR's vision anticipates a reorientation of focus by applying strategic thinking and leadership, using forward-looking strategic objectives, KPIs supported by a strategic holistic risk management framework, in short, adopting a business-like approach to running a pension scheme. This is the regulator's expectation that the way that you engage with administration is not going to be poring over those reports, but looking at the challenges, the challenges that are in front of you. And of course, we are seeing through the DWP consultation, which we had just before Christmas, it closes next Friday, that DWP is very interested in how pension schemes are governed, how they're run, and also the role that administration plays in that. And I was fortunate week before last to be invited to the ministerial roundtable on administration. The minister was there for about an hour and a quarter of the hour and a half that the roundtable ran. And if you've heard the minister, you will know he's incredibly sharp, he's incredibly bright, he's actually very knowledgeable about pensions. But what really struck me is he understands the pensions administration market. He understands the challenges at a fairly detailed level that the industry is facing. And he asked really quite searching questions about why certain things were happening in the market. Now, probably, given I'm chair of PASA, it's probably no surprise, given that one of the questions within the consultation is around whether the government should introduce legislative standards around administration, that I put my case of why PASA accreditation was the way forward. And it seems to me that if government introduces a set of legislative standards, then typically the way these things work is it will probably take 2 years for the minister to get a bill, a year of sort of consultation, a year to get primary legislation through, a year to get secondary legislation through, a year for TPR to put that into a code and guidance. So if the government decides to go down a statutory process of standards, that's not actually going to hit the market for another 5 or 6 years. And given everything that I said up front about the pace of change of what's happening in our marketplace, my real fear that is if the government goes down the track of introducing legislative standards, by the time they are introduced, the world will have moved on, and you'll have a set of standards which are not fit for the market they're trying to be there. What we have done at PASA is look at TPR's general code. I have to say it's a brilliant document. Whoever wrote it did a fantastic job of producing that. But what we have done at PASA is look very closely at the requirements of the general code, reflected that in our standards. So if you are an accredited administrator, you are meeting the regulator's requirements as set out in the general code. For me, there's not an argument to say PASA standards are too high. They reflect the requirement of the regulator in administering pension schemes. Now, actually, I do think there is a possible rationale for saying, actually, for these mega funds and super funds, once they're up and running, super funds also have the potential to become incredibly large. In the same way, I think DWP is probing to say, should the trustees who sit on top of mega funds be more experienced, more skilled, be held to a higher level than a regular trustee? There might well be an argument to say, actually, if you're administering a mega fund, you have to be held to significantly higher standards than if you're just looking after a run-of-the-mill. I do think there is something very different about running a pension scheme that has got millions of members' data in it. The opportunities that are presented to you are very different, but the risks, as I said, are also quite significant. So I do think maybe for certain types of scheme, it could be that there is a different level of standards required, and PASA is very much open to setting a higher level of standards and accreditation, if you like, for particular types of scheme. We were very pleased to see that TPR, in its updated guidance, which it issued just before Christmas, set the expectation that if trustees are looking for a new administrator, they should seriously consider a PASA accredited administrator, and if not PASA accredited, then they should ask questions of why accreditation's not been sought. Again, you'd probably not be surprised that I asked the Minister if he would consider urging TPR to provide stronger encouragement to people, almost an expectation that all administrators would become PASA accredited. And I still do think that that is a better, I realise that is putting an extra task on administrators. But I do think actually getting the standard of administration up, getting it to the level, to the PASA standards, is preferable to having a mandatory government administration set of standards. So I think if you are in pensions, if you're in pensions administration, you're going to have quite an interesting few years. I do think it will be a bit of a roller coaster. There are going to be some quite significant challenges. As Leon said up front, we're acutely aware that actually attracting talent into pensions and pensions administration is challenging. A lot of people, I think, are having to grow their own administrators because actually there's just not enough in the market for the task that faces us at the moment. So I think there will be some challenges. I do think it's quite exciting though. You know, we are going to have a super fund authorisation regime. We are going to see more super funds come forward for authorisation, start operating in the marketplace. We are beginning to see a lot of interest in setting up CDC arrangements, sometimes multi-employer arrangements going across industries. And they do require kind of a different mindset, an interesting new challenge for people. So there are going to be some interesting new challenges and opportunities in front of us, but I think it will be a bit of a roller coaster. One thing which I think has changed, you know, if I look back, the idea that a pensions minister would convene a round table to talk about pensions administration, I would have said that would never happen. It has now happened. The minister sees that pensions administration is critically important for delivering all the policy changes that he wants to deliver. It's strategically important to getting good member outcomes. So pensions administration is now at the top table, and I don't think it's ever going to leave the top table. So you're in a very interesting and exciting industry. Thank you. So I have left, I think, 5 minutes for questions. Quite happy to take questions on anything I have said or anything else that people want to ask about.
Thank you. Can I ask a question? In your opinion, how do we go about making sure that life becomes a bit easier for people working in pensions administration? I mean, I think GMP equalisation is the biggest example of something done by, the horse by committee, because a lot of people seemingly, in my experience, made a lot of money out of GMP equalisation, and it wasn't the better. And we have just made something so simple, so complicated, and it all washes down into one place, which is pensions administration. We talk about how vital it is, how important it is, how important it is with the schemes. I mean, I work at Procentia. We see pension schemes with such varieties of flavours of benefits. It makes it almost impossible to automate some aspects of the pensions administration because of the various different outcomes, the benefit checks, the underpins, the myriad of different things that layered on. So in your opinion, how do we go about trying to get it simplified so that these guys that are working in pensions administration have half a chance of getting it right, and half a chance of kind of automating the processes that will allow members to get the best outcomes in a much more efficient way in a world where, as you say, it's only getting bigger?
Yeah, I've got a feeling my answer to this is probably not going to be that uplifting and hopeful. I mean, part of the challenge is what I was trying to illustrate when I talked about the Tony Blair Institute is you sort of get an idea into government and then it just kind of builds its own momentum. And even though, in the Tony Blair Institute, the analysis was fundamentally flawed, it nevertheless has created a kind of direction of policy travel, which is now like a supertanker. It's not going to get stopped. I would probably say, when I was writing the value for money regulations, it was for a world where there was something like 1,400 DC schemes, and that was not the right number. If the government's successful at getting down to 6 to 12 DC mega funds, frankly, what it should do is just put all the value for money consultations that it's working on at the moment in the bin and start afresh for a world where there's just 6 to 12 mega funds. Because you don't need what's in consultation at the moment. Is that going to happen? No, because I think, again, it's just got a momentum and steam it's just going to go. So I could see that administrators, trustees are going to spend a lot of time generating stuff which actually, a little bit like GMPE, at the end of it, you kind of think, well, what really was the point of that? So inevitably, you're going to get those things. I think if I was trying to be hopeful, then I think, technology is changing. The power of computing is becoming cheaper, so the ability to do things which weren't possible is now becoming possible. And I do have a kind of high hopes about AI. My own firm has kind of tried to use AI to say, here's the trustee, here's the admin manual, here's the data, set this up on our administration system. And it probably gets it right in about 50% of cases. The pace of AI is such that I don't think it'll probably be too far in the future where actually that might actually work to a significantly higher degree. So some tasks, I think, are going to get much better with technology. I think the big shift from the dashboard to require accurate data, digitize, and drive automation, I think will open up new possibilities so that people will do. And I sort of think administrations change. I'm very ancient, so actually I started doing GMP calculations with a piece of paper, a calculator, and a pen. I do think an administrator's job now is about using technology, project management, communication. It's a very different job, and I think we'll have that evolution. So I think administrators are going to be in enormous demand going forward. Their jobs will be different, but hopefully they'll be different because technology, AI, takes some of the drudgery out of it and gets them to be able to do more interesting things.